I'm willing to bet some of these brands are in your home right now. They're household names, right? Staples we've all come to know and trust. And they all belong to a single company, one that has built an absolute empire on that trust, but is now facing a real moment of truth. This is the story of the Clorox Company. But behind these powerful, everyday brands is a company at a pretty critical crossroads. Today, we're going to break down the story of Clorox and a major challenge that's looming on the horizon, what we're calling the earnings cliff. Okay, so let's get right into it from an investor's point of view. For decades, Clorox has been that safe, defensive stock you buy and don't worry about. But with the challenges it's facing now, is it still a safe bet, or could it actually be a value trap in disguise? Let's dig in and find out. To really understand Clorox, you have to start with its greatest strength. It has this incredible competitive moat, and it's built entirely on a portfolio of truly dominant brands. Think of it like a literal moat protecting a castle from invaders, But for Clorox, that moat isn't filled with water, it's filled with decades of consumer trust and brand loyalty. That's what keeps the competition at bay. And this right here is where you see the power. We're not just talking about familiar names, we're talking about brands that are number one or number two in their categories. That kind of brand strength is a huge asset. It lets Clorox charge a little bit more, it gets them the best shelf space in stores, and it keeps customers like you and me coming back. This is the bedrock of the entire business. But even the strongest moats can be breached, and the tallest walls can start to develop cracks. So now let's look at where that foundation is beginning to show some serious strain. The first crack, it's geographic. A whopping 85% of Clorox's revenue comes from the United States. Now that speaks to its strength at home for sure, but it also creates a major risk. Unlike its more global competitors, if the US market slows down, Clorox really doesn't have much of a cushion from other parts of the world to fall back on. Next up, let's talk size. Clorox's market cap is around $15 billion. And yeah, that sounds huge, but in the world of consumer goods, size is relative. And here is what relative looks like. Clorox's biggest rival, Procter & Gamble, is over 20 times its size. That is just massive. And this isn't just about bragging rights. That incredible scale gives P&G way more firepower for research, development, advertising, you name it. Clorox is in a constant battle against an absolute giant. This creates a situation you could call the innovation treadmill. See, in a slow-growth market, Clorox has to spend a ton of money on R&D and marketing just to keep from losing ground to giants like P&G and all those cheaper store brands. It has to keep running as fast as it can just to stay in the same place. And these pressures, they show up right here in the numbers. The company's own Ignite growth strategy has consistently fizzled out. Their target is 2 to 4% sales growth a year, but look at this. Aside from 1 year, they've missed that goal, sometimes by a lot. This raises some really serious questions about the company's ability to actually generate organic growth. Okay, but all of those are kind of long-term headwinds. There is a much bigger, much more immediate problem right on the horizon. Let's talk about the main event, the fiscal 2026 earnings cliff. So, what is this cliff? Well, it all comes down to a planned software upgrade. To avoid any potential supply disruptions, retailers bought a huge amount of Clorox products in advance during fiscal 2025. You can think of it like this. They did their 2026 shopping early. Those sales got pulled forward into the wrong year. And on the surface, this made fiscal 2025 look fantastic. The company reported a gross margin of 45.2%, a really impressive number showing strong profitability. But there's a catch. And the catch comes directly from Clorox's own management. They've stated very clearly that this benefit from all those extra sales is temporary, and it's going to completely reverse in fiscal 2026. In other words, they basically borrowed sales from the future, and now that bill is coming due. So here's the play-by-play. Retailers bought early, which puffed up 2025's numbers and made them look great. Now, in 2026, those retailers are all stocked up and they won't need to buy nearly as much. The result? A guaranteed significant drop in sales and earnings. And here is the punchline. This isn't my speculation. Management has explicitly told investors to expect adjusted earnings per share to decline by a staggering 22 to 25% in fiscal 2026. That is the cliff. So what on earth does a guaranteed earnings drop mean for someone looking at the stock today? Well, this is where we uncover that potential valuation trap. Here's how the trap is set. An investor, looking backward, sees a trailing PE ratio. That's the price you pay for past earnings of about 18. And that seems pretty reasonable. But here's the thing. Investing is all about the future. When you calculate a forward PE using the earnings Clorox expects to make next year, that number jumps to 23.5, and suddenly the stock looks a whole lot more expensive. Let me just state this as clearly as I can. An investor buying Clorox stock today is paying a price based on a level of profit that management has already confirmed will fall by almost 25% next year. That's the trap right there. So all of this brings us back to the central dilemma, the key question for any investor looking at this company. On one hand, you have these undeniable strengths, iconic brands, and a management team that is really good at managing costs. But on the other hand, you have clear weaknesses, sluggish growth, and way too much reliance on the U.S. market. And then you have the wild card, that massive pre-announced earnings cliff. And that leaves us with one critical question. Is the incredible, enduring power of these brands strong enough to get the company across this earnings cliff? Or is the stock simply too expensive for the reality that lies just ahead? For any investor, that is the multi-billion-dollar question.